I really hate to break up a good time. It does my heart so good to see so many wonderful friends and family and other leaders in the community enjoying our beautiful river city this morning. And I don't know that you could find a better venue than Pelican Landing for a morning like this with the sun looking out over the river. It's just beautiful. For those of y'all I don't know, my name is Clayton Legier, and I serve as Chief Executive Officer of Merchants and Marine Bancorp. My assignment first thing this morning is a very brief one, which I know many of you will be very thankful that it's brief because I can be long-winded sometimes. But it's my privilege to introduce a very special guest today, someone who needs no introduction in Jackson County, especially not in the River City. And this is a leader who we have watched step in and answer the call of leadership time and again, someone who's been willing to step into the darkest places when our community has endured hardship, someone who's been there to help celebrate whenever great accomplishments have happened, and someone who is exactly who we believe Moss Point needs to continue moving forward toward its full potential. Without further ado, it's my privilege to welcome to the stage Mayor Billy Knight.
Good morning. Thank you, Clayton. That was good. I didn't expect that. I am excited about being here this morning and excited about having you all here. And, you know, you heard Clayton say the River City. That's what we call Moss Point. And then we call it that because we have the river right downtown. And for those of you that have not been here before or have not been here for a while, I hope you find time to just ride downtown and see what that waterfront looked like. It doesn't look like very much right now, but I want you to see it now so that when you come back, you'll be able to see the difference. Because we're getting ready to revitalize downtown Moss Point with mixed-use development. And we hope that you will come back at some point to really see what it looked like. Out on I-10, we're doing the infrastructure on I-10 and Highway 63. There's businesses there now, but we're getting more and more coming to Moss Point. So Moss Point will look different, we think, within another couple of years. So again, I am so excited to have you here. I want to thank M&M Bank, Clayton, Chairman of the Board, Mr. Royce Combus, all of your staff for agreeing to come to Moss Point to have your corporate meeting. What I am trying to do in Moss Point is to get more eyes on Moss Point. Moss Point has not been as well known as most of our other cities on the coast. And I'm trying to change that. So inviting people like you to come to see what our city looked like, see the potential of Moss Point. Then you go back and tell other people, I think will be the beginning of how we grow and change Moss Point. It's all about image. It's all about economic development. And that's what we're trying to change here in Moss Point. I will not be able to stay this morning. I wish I could, but let me just tell you why. At 10 o'clock, I will be going up to an area we call Bennett Bayou, where EPA will be here announcing a $2.5 million grant to the Land Trust to do some development here in our southern state cities. You know, last week, we had the Deputy Administrator from Washington, D.C. of Transportation came to Moss Point and presented me with a check for $400,000 to begin evaluating our gas lines. So we are beginning to get some attention, not only from our state, but also from the federal government. And it's because of the things that I've been asking all of our citizens to do. And M&M Bank is a part of that. And that is to believe. Believe in yourself, believe in your neighbor, and believe in Moss Point. We had a terrible tornado that hit us on June 19th last year. Over 100 structures was damaged. Houses, businesses. And your bank was one of those. And we're excited about seeing that beautiful picture that was put up a couple of days ago as to what that new structure will look like. Again, I thank you for agreeing to stay in Moss Point and help us rebuild. And that's a part of that believing in yourself, believing in your neighbor, and believing in Moss Point. And when you do that, there is nothing we can't do working together. So thank you so much for coming to Moss Point. You're always welcome to Moss Point. And I hope that you have a great symposium here today. Thank you very much.
Thank you, Mayor Knight, so much. Thank you, Mayor Knight, for your unwavering leadership and your commitment to Moss Point. The results are beginning to be apparent, and we are honored to be a small part of it. Thank you. It's an honor to stand here between the gentleman that just spoke and the gentleman that is about to speak. They are two men that share a lot of common traits. They have both dedicated a significant portion of their lives to educating others and lifting up others. In addition to that, they are two men that exemplify the highest moral and ethical standards and qualities of leadership. They display a commitment to doing the right thing and a dedication to truthfulness and honesty, even when they know that it will not be popular. Dr. Craig Lewis is our economic speaker today. Dr. Lewis has a BS in accounting from The Ohio State University and his MS and PhD in finance from the University of Wisconsin. He is the Madison Wigington Professor Emeritus of Finance at the Owen Graduate School of Management at Vanderbilt University. He has expertise in financial market regulation, corporate finance, asset management, asset pricing, financial accounting, and the list goes on. In addition to all these things, he's also the former chief economist of the Securities and Exchange Commission. Dr. Lewis has been here for 2 years now. This will be his third year, and so far he's batting 1,000. So the good news is, as Greg Hodges reminded me the other day, that even a 667 will get you in the Hall of Fame. So the pressure's off a little bit this year, I guess. Without further ado, I'd like to introduce you to our speaker today and my friend, Dr. Craig Lewis.
Good morning, everybody. It's great to be back here again for my third installment. I've had the privilege of being able to present at the annual shareholders meeting. This will be my third year in a row, and thank Clayton and Casey for being willing to let me come back down to the area and talk about how I think the economic situation looks a little bit going forward. I'm going to basically break my conversation or my discussion into really three areas today. I'm going to talk a little bit about current market conditions, where we've been, where we're going. Part of that is going to be, Casey asked me if I'd spend a little more time talking about inflation and how inflation looks. So I thought I would give you a little bit of a primer, if you will, on inflation calculations and how they're made. How we traditionally have looked at inflation using something like the Consumer Price Index, how the Fed looks at personal consumption and expenditures, PCE, which is an alternative way of thinking about inflation. Just draw a little bit of the difference. I'll show you how good the Fed has been at forecasting inflation over time. Not very good, to kind of give you the punchline ahead of time. And then I'm going to give a little bit of a discussion about a return almost to what I talked about last year. Last year, I spent some time talking about all the recent bank failures at Silicon Valley Bank and First Republic and what caused those banks to get into trouble. And I'm going to show you that a lot of those factors are still at play. We've already had another bank failure this year, which its profile looked very similar to what we saw last year. And I'm going to draw an analogy or comparison between some of the metrics that people look at for pricing and show you that there's good news and there's bad news. It just depends on what you know about the institutions themselves. And then I'm going to pivot to a discussion about some of these risk factors and how I would evaluate Merchants and Marine Bank along these same factors. And I'm going to show you that I've picked 18 different comparable banks. And at the end of the day, I'm going to show you that your bank is the most highly ranked bank among all your competitors, right? Same message I gave last year. Remarkably, you haven't really shifted from that. So I thought it would be informative to go back and take a look at some of these factors again, but look at current data. So that's where I'm headed with this. So I'm going to begin quickly by talking about asset class performance. And this graph that you see, I think, on the screens to my right and left, really represent two different indexes. One is the S&P 500 index, and the other is a corporate bond index. And one of the things I predicted last year was I didn't think the bond market was going to be doing very well, and because of what I viewed at the time, increased inflationary pressure. Right? I was less optimistic than the Fed about where I thought inflation was going to be. I viewed it as a major risk factor. I continue to think of it as an important risk factor going forward. And as one might expect, when rates go up, bond prices go down, right? And so basically that's what we found. We found that as a class that if you thought this is a 2-year picture, so if you think about that second half of that graph, you can see the bond market really underperformed relative to the stock market. The next graph I'm going to show you is, I think, informative that the two lines at the top, the blue line once again is the S&P 500, but the gray bar below that is a bank ETF. And one of the things that I found really interesting about this particular graph is just how closely bank stocks track the market in general, right? I've historically have thought of banks as being less risky than the market and that they wouldn't perform at the same level, and I would have expected maybe a bigger gap, but they really are trending almost in the exact same way. That bottom red line that seems to have a lot more volatility, that's the price of Bitcoin. So if you want to get a sense for what's been happening in crypto markets, you can see that when I started this analysis, I put $1 in every single one of these investments and just tracked their performance over the next 2 years. And you can see that over the last year, Bitcoin has done pretty well, but if you would have put $1 in 2 years ago, you would still be at about 80 cents in the dollar, right? So crypto markets are very volatile relative to more traditional equity markets. Now, this next graph is, once again, the blue line is the S&P 500, and that green line that seems to be bouncing around quite a bit, that is called the VIX. That is a volatility index, and what it is it's a forward-looking estimate of what the market believes how volatile the stock market is going to be going forward. And what you can see is that those big spikes that were really taking place in the middle, that was right around the time of the Russian invasion of the Ukraine. And you can see that that invasion impacted our stock market quite a bit. And you can see that, not surprisingly, when volatility goes up, prices come down, right? So the more risk we see in the market, investors expect to be compensated for taking that type of market risk on. And so when risk goes up, they expect greater compensation, which means prices come down because the yields are going to go up. So, but notice toward the end, we see that the VIX is really stabilized, right? That there isn't really nearly as much concern about market volatility. Over this entire graph you're looking at, the actual average volatility was somewhere around 20% per annum, we're looking right now at about 14% per annum, so we're actually below what has been the recent trend in volatility, and so markets look reasonably stable, right? And because of that stability, you can see that the S&P 500 has done pretty well over the last few months. Now, what I'm going to talk about next, I'm going to skip forward, this is inflation. So how is inflation measured? Well, traditionally we think of the Consumer Price Index, and there are a lot of components to this Consumer Price Index, and this is just a list, but you can see that it includes things like food and beverages, housing, apparel, transportation. And the way the CPI index is actually put together is they take various prices for these different components, but they're based on a survey of how much people are willing to admit that they're spending on these various components, right? So they'll survey consumers. So somebody will say, well, I spend 15% of my monthly income on gasoline. I spend 5% of my monthly income on groceries, and I spend maybe 2% of my income on alcohol, right? So it just goes up, and they take these, they put them together, and then they go out and observe the prices, and they weight this index by what those prices are. And that's how they come up with the CPI. So if prices for gasoline go up, that component of the CPI goes up. And so that's really how the government has been tracking, the Bureau of Economic Statistics has been tracking this. Now, there's an alternative metric, and if you've been reading the paper recently, you'll see that there's a lot of discussion about this PCE index, the Personal Consumption and Expenditure Index. And the Fed has claimed they believe that that is a better measure of inflation, that they pay more attention to this than they do to the other indices. And personally, as an economist, there's a valid basis for that. And the reason I think that there's a valid basis for that is because whereas the CPI is based on surveys, the PCE is based on actual consumption. So they actually are measuring how much people are actually spending as opposed to how much they're willing to report they spend. And to give you kind of one, I think, slightly amusing anecdote, the weights that people spend on alcohol actually spend on alcohol is twice as high as what they're willing to report what they spend. So there are some clear biases in the way the CPI is put together. So as a data-driven type person, if I can base something on actual data, I tend to view that as better than somebody who's telling me what they think they do, right? So that's an interesting sort of way to do it. Now, there's an alternative way. I mean, one of the reasons why I believe the Fed is interested in this is it does make sense at sort of an economic level why that might be a better measure. But they also changed how they calculated the PCE in the last year. And in the past, it's been based on a 2-year average, and they changed that average to 1 year. And so by changing it to 1 year, what they did was they were able to sort of make the really high inflation period from 2 years ago disappear from the statistics. So it tends to generate lower inflation estimates. So there's a little bit of, be a little suspicious of why the change was made, but the change in methodology appeared to be a way to game what they thought was a bad inflation period for the Fed and sort of wipe it off the books, right? So while I think it does make sense to use it, the change in the methodology does look a little suspicious to me. But let's now ask, well, how good, let me go back to where I was before here. So let's go, now what I did is I said, how good has the Fed been in the past at predicting the actual inflation rate? So the Fed on a monthly basis publishes what it believes to be an inflation forecast for the next year going forward. So they publish a 1-year forward inflation rate every month. They also publish a 5-year inflation forecast every month. So what I did was I went back and I said, for this graph, I said, let's look at what the inflation forecast was a year ago, and let's see what the actual inflation looked like over the year. And so this is literally kind of a moving average graph of comparing the Fed's forecast to what actually happened. So how good was that forecast? The blue line is what actually happened. The red line is their forecast. And what you can see is while they have actually improved because that gap has shrunk a little bit more recently, they really aren't very good at it, and they systematically underestimate the actual inflation number. So their forecasts over the past year and a half have systematically underestimated what the actual inflation was. So let's look at the 5-year forecast. Once again, I went back and said, what was inflation actually like for the past 5 years? And then I went back and I asked, well, what did they forecast 5 years ago? And here you can see that the numbers are pretty stable, right? That they systematically underestimate inflation, and to a significant degree. And this is, I think, consistent with, if you paid attention to some of Jerome Powell's remarks, I think the Fed is still unable to really, I think, understand what's driving inflation. Right? They don't quite understand. Their models that they've been historically using don't do very well, and I think this is the type of evidence that I would point to suggest maybe they don't do so well. Right? And so that becomes a problem for them. All right. So we have these two competing indices now. So what I'm going to do next is I'm going to show you, just jump ahead, this is the forecasts from the Fed compared to the forecast from the PCE. And they really kind of lay on top of one another. There actually isn't a whole lot of real difference between a CPI inflation estimate and a PCE estimate. The only thing you can say is that little gap that you see kind of widening up where it's big, that biggest gap where the PCE is the orange line, where it's below, that's about the time the methodology changed, right? So it gave you some initial sort of benefit by making the inflation rate look lower, but you can see now they're pretty much on top of one another. So, and historically, I would say there's not a statistical difference between the two, right? And so you get about the same thing with either measure. So now let's go back, and another thing that Casey was my student in my MBA class at Owen, long time. We won't say how long ago, Casey, but a while back. And one of the things I always told my students was, if you really want a quick estimate of inflation going forward, the best place to look is the U.S. Treasury bond market. That historically, the U.S. Treasury bonds have basically their compensation. What you get when you buy a Treasury bond is you get compensation for holding inflation risk. So there's a real return embedded in a Treasury bond of about 50 basis points. You want a quick back-of-the-envelope forecast of inflation, just take the Treasury yield, subtract 0.5% from that, and that's a pretty good estimate of inflation. It's the market's estimate. It's not the government's estimate. It is the estimate of people who actually put their money where their mouth is. And so I think that's a fairly reasonable way to think about how to come up with a quick back-of-the-envelope inflation calculation. And what you can see is that I've plotted the yields on these things, but you can see that these are Treasury yields, and you can see how much they've gone up in recent years. The top line is the short-term 3-month Treasury bill yield, and the two yields below that are the 5 and the 10-year yield. And you can see from this that they're well over 4%, right? So if you're thinking, and that's going out 10 years, so when you get a 10-year Treasury bond, that's implicitly telling you what the market thinks the inflation rate is going to look like for the next 10 years. Right? And so you can see that the market is telling us that it thinks inflation is kind of here to stay for a while longer, that it's not, it may drop a little, but maybe not that much. So what I've done is I've gone ahead and put together what I think the inflation numbers are, what I think inflation rates are going to look like. So this is where I haven't gone out on this much of a ledge in the past, but I'm going to provide some forecasts. And if I look at what the Fed thinks inflation, they have it picked at about 2.7% for the next year. I actually think inflation is going to be higher. My guess is it's going to be somewhere between 3.1% and 4.56%. So I think it's going to be higher. I think it's going to be hard. Their target is 2%. I think they're going to have a difficult time getting that number down. And I think part of that is because they understand inflation is going to stay high, right? And I think it's going to be probably higher than they believe it's going to be. What I think that means in terms of rates is I don't think interest rates are going to go up anytime soon. But I also, because it's an election year, but I don't think they're coming down. Right? I think most of us would like to think that there may be a rate cut by the Fed. My personal view is that's highly unlikely. And if it does come down, it's going to be a relatively small amount. Right? So maybe small 25 basis point type reduction. It's not going to be down to 2%. We're not going to see those really low interest rate periods for what I think will be a fairly long time going forward. So as a prognosticator, I would say rates aren't going up. Right? I think there's very little risk that you're going to see a rate increase. I think maybe a very tiny rate decrease, but honest, my best guess of what I think is going to happen over the next year, they're going to be where they are today for a long time, right? And that's because we're still worried about inflation. And as long as the inflation rate is greater than what the Fed is willing to sort of provide as their bank rate, we're going to see them stay. So that's my forecast for inflation. A little bit of a primer on inflation calculations. I guess the takeaway would be the Fed hasn't been very good recently at identifying what these rates look like, but I think we're going to see inflation for a while. All right, now, I spoke at length last year about what got banks into trouble, and I decided that this is the first major bank failure. I thought it was entertaining because last year I talked about Silicon Valley Bank and First Republic. The irony is that the first bank failure of the year was Republic First. So just take First Republic, flip it over, now you have the next bank failure. And what I think was interesting about the First Republic bank failure is it had all the same earmarks of what got Silicon Valley Bank and First Republic in trouble, right? It faced declining deposit base, right? So where deposits are leaving, your loan portfolio is pretty stable, right? Because people aren't going to find better deals. So your loans are staying on the books, but the depositors are leaving, right? So basically, you're losing, right, depositors. They also had, their loans became less valuable, right, because now interest rates were going up, and their loan portfolio didn't look as good on a market value basis. And the other thing is they tended to be holding a lot of bonds that had long maturities, which lost value. The exact same thing that got Silicon Valley Bank in trouble, right? And so they found the same thing. Now, the reason why I decided it would be kind of entertaining to put this up is this graph that you see, it came from a slide deck that the bank put together for its annual shareholders meeting. And what they were doing in this deck was they were trying to convince shareholders that look at the head, Republic First is a compelling investment, right? And so what they were doing is they were saying, here are all of our competitors. Kind of the same analysis that I've been doing. We're going to look at what their price to book ratio is. And all the price to book ratio is the market price of your stock divided by the book value per share. And they're pointing out that if you buy a share of Republic First Bank, you only have to pay 24 cents in the dollar for a dollar of book assets. Sounds like a really good deal, right? Because most banks sell at above $1 a share, right? So most profitable companies, right, they're doing well, have price-to-book ratios greater than 1. And you can see that a lot of these comparable banks did, but Republic First was doing poorly. And so is it a compelling investment? Or is it a terrible investment because the reason their price is so low is because they're doing poorly? Well, it's clearly the latter. They went bankrupt, right? And they had to be absorbed. So a small price-to-book ratio means either it's an interesting investment opportunity. I guess compelling is probably not the word we would use ex post, but certainly it was an investment opportunity, but it just turned out not to be a very good one. So why do I point this out? Well, it's because your banks price to book ratio is about 0.54, right? So is that a good investment opportunity, or is it a sign of a bank that's not doing very well? I'm going to try to make the case as a shareholder, as fellow shareholder, that it's a good investment opportunity, and that's why I'm a shareholder. I would like it to be better. I would like it to be higher personally, but where we are now, it still looks like an intriguing investment. So what I'm going to do is I'm going to put together kind of an analysis for you to show you why I think this is not Republic First, why this is actually a very solid, well-capitalized bank. And so these are a set of comparables that I put together, and I used two sources. I asked Casey who he thought some comparable banks were, and he provided me with a list. But then I went to ChatGPT, and I said, I want a set of 12 comparables that for Merchants and Marine Bank. And it gave me a set of comparables, and so I put those together. And so the first thing I'm going to show you is that same price-to-book ratio analysis. This is Merchants and Marine Bank against all the comparables. And what you can see is if you're on your left, the company on your left is Merchant and Marine Bank. And if you compare on December 31st, Merchants and Marine Bank had the lowest price-to-book ratio. So you paid less for $1 of Merchants Marine Bank on a book value basis than you did for any other comparables that I've identified. And if you looked last week, it was in third place, right? So it had slipped a little bit relative to the peers, but I mean, basically, it's an incredible value, right? If you think this is a solid bank, if you think it's doing well, this is a solid investment, right? And if I was teaching my class, I spent a lot of time talking about markets are efficient, right? Investors look at companies, they take the public information, they process that, and they come up with a valuation. And I try to convince my class that on average, investors do a really good job. Well, I think there's a lot. I don't think this is an efficiently priced stock. I think this stock is underpriced quite a bit, right? And so this is the first piece of evidence that I would have for that. Now I'm going to try and convince you that other metrics I think are important, right? So this next one is basically how much equity capital do you have? So if you are a bank regulator, the first metric that you care the most about is your equity capital, your bank capital ratio. Right? The more equity you have, the better your depositors are protected from bank runs. Right? So equity serves as a buffer, right, between the loans you've made and the deposits you have. And so the more equity you have, the more of a cushion you have if some of your depositors decide they want to leave. And so on this metric, Merchants and Marine Bank is that green bar. It has the second highest equity ratio of any bank. Okay? That's a good thing, right? The next thing I'm going to look at is, I might have to jump down here to read my slides. This next one is insured deposits to uninsured deposits. And the reason this is important is that what we learned from some of the bank failures last year is that uninsured depositors tend to run at the first sign of trouble. Whereas people who have their deposits fully guaranteed by the FDIC, they don't care as much, right? They know that they're going to be paid if the bank fails, so they tend not to leave in a crisis. So the uninsured deposits, which is really what got Silicon Valley Bank in trouble, left at the first sign of trouble. And so what you can see is that Merchants Marine Bank is somewhere, around the fifth or sixth highest ratio of insured to uninsured deposits. So you want that ratio to be high, and they are quite high. They're certainly way better than the average bank in this scenario. The next thing I'm looking at are loans to deposits, right? So this is another sign of like, well, if you have a problem and people leave, you want your loan to deposit ratio to be small, right? You want a lot of deposits so that if you do have people leave the bank, the loans are going to be protected, right? So you won't fail. And so Merchants and Marine Bank is probably the fourth best looking bank among all the comparables on this metric, right? So a stability issue, right? Are you susceptible to run risk? And these two charts show this bank is not susceptible to bank runs. The next thing I'm going to look at is cash to deposits. How much cash do you have? You have an incredible amount of cash relative to your peers, right? A lot of cash that's sitting on your balance sheet that could be used, right, for basically any purpose, acquisitions, whatever, but you have a lot of work, a lot of capital. So these are all, I think, pretty interesting measures of stability. This next one would be a measure of how much do you have. So one of the things that got some of these recent bank failures became problematic is that they had a lot of treasury bills that had very long maturities, right? And when interest rates went up, those long-dated treasury securities went way down in price, right? And so now these assets on your balance sheet have become a lot less valuable, right? Which makes you look less stable. And so what I tried to do is I said, well, how much do you have in these assets which are pretty safe? So when you have, instead of long-dated maturities, do you have a lot of relatively short-dated treasury securities? Because they're a lot less sensitive to changes in interest rates. And so once again here you have a fairly high level of these relatively safe treasury securities compared to your deposits. And I viewed that as another metric of stability. This is one where you slipped a little bit relative to last year, but it's still not bad. And this is as a fraction of all the investments you have in treasuries, how many of them are long dated. And I think of the 18 comps here, you were in 9th place this year. I think you were in 6th place last year. You didn't change very much, but you got a little worse relative to your peer group. But at the same time, the actual absolute percentage got better. So it just means that while you got rid of some of your longer term bonds, other companies were a little more aggressive in terms of getting rid of some of those from their portfolio. But on net, this is a little heat map I put together of all those metrics I just looked at. And the less green you see, the better you are, right? So this is just a heat map. And what you can see that on all these metrics, you are better than average on every single metric. But I created a ranking. I took all these various metrics and I ranked, and across all these various metrics, you had the highest rank of any of the banks in this peer group. So from a safety and soundness of the bank standpoint, Merchants and Marine Bank is number one in class, right, across all of its comparables. So when you sort of try to look at the aggregate picture, you come out on top, which I thought was a pretty interesting result, right? It's where you were last year. So basically where you are this year is pretty much the same where you were last year. And almost on every metric, you really were in about the same spot. So that's basically what I had as far as the presentation goes. So thank you.
Craig, thank you so much for joining us. Always an honor to have you, sir. We do have about 10 minutes for any questions that y'all might have of Dr. Lewis while we have him before he escapes to another far-flung locale. So while we have him, y'all have anything that you'd like to ask? Mr. Harper.
So, Dave, I don't know what's going on behind the scenes at the Fed and how much they're using generative AI to help them with their forecasts. That's just something I don't know. Pretty sure that their economists are probably playing around with that, just to be honest. But I don't know for sure. It's certainly, I don't think, a part of the formal process at this point. What they do have is they have these very large, sophisticated input-output models for the economy where they really do try to forecast aggregate demand and aggregate supply, and traditionally those are the models that they've used to derive or develop their inflation forecasts. But like you, I find generative AI, I find it really intriguing and interesting.
Yes, sir.
Dr. Lewis, are you concerned particularly about the effect to the equity markets should China move on Taiwan, or should we have another pandemic, or Lord forbid a meteorite, just all kind of potential disasters that could strike and set off chaos in the market? So I just kind of wanted your take on that.
So I'll lean a little bit on my experience at the SEC, and one of the things that happened right before I came as a visitor was the flash crash, right? And so one of the things that the SEC has worked on is trying to make markets more resilient to types of large shocks, exogenous shocks that could occur that might dramatically affect people's willingness to invest. And I believe that they've put a lot of guardrails in place that are designed to slow sort of trading down during moments where you don't quite understand what's going on. And so there are all kinds, there's circuit breakers, there's something called a limit up, limit down rule that's designed that if stock moves outside of a certain band, we're going to shut the markets down for a period of time. Hopefully liquidity will develop. When we open it back up, we'll start to trade again. There are market-wide versions of that. Now, one of the things that happened recently was kind of the meme stock episode, right? Where we saw companies like GameStop go up to unprecedented levels, right? And so did the markets work well during that period of time, or didn't they work well? Yeah, that's still kind of an open question. But at the end of the day, I do think the markets are pretty resilient. I think they're very resilient, and I think they accommodate trading, and even during crisis-type periods. I guess the biggest concern that I have is kind of where the SEC is going right now. They have a number of market structure rules that have been proposed that I think will make it more difficult to trade certain types of stocks. Currently, I don't know how familiar you are, but like if you were to, let's say you had a Schwab account and you wanted to buy shares in Merchants and Marine Bank. You go to your Schwab, go online, you put in your order, I want to buy 200 shares of Merchants Marine Bank, and you hit the button, that order is going to be executed immediately, almost nearly instantaneously. And the reason why your order as a retail investor will be executed that fast is because Schwab uses what's called a wholesaler. So they use a firm like Citadel or Virtu, and that order, Schwab just immediately routes that order to Citadel or Virtu. And they choose which one of those wholesalers to send it to based on where they think they get the best executions. Well, Citadel has kind of an implicit obligation that it has with Schwab. It will buy that stock for you. It will sell you, whether they have it or not, they will sell you Merchants Marine Bank shares. And then they go out and they try to find it in the market, right? And so the SEC has been, tell me if I'm going too long with this, Casey, but the SEC basically now is saying what we're going to do is we don't like that model, which is, in my mind, ridiculous, because if you've ever traded stock, it's pretty hard to beat the cost of trading equities in today's markets. And most of the time, if I trade a share of stock, I actually get what's called price improvement. So I do better than the national best bid and offer price. Usually, I will typically get a price that is better than what it looks like I should be able to get. And that's because these wholesalers know that when Craig Lewis comes to buy a share of Merchant Marine Bank stock, he probably doesn't really know what he's doing, right? And so they view retail order flow as uninformed, right? They worry about big institutions trading against them because they think institutional traders know what they're doing. They think active portfolio managers know what they're doing, but they don't think the average retail investor knows what they're doing. So they give me a better price because they don't have to worry as much about me knowing something that they don't. So the SEC has decided there's not enough of this price improvement taking place. So we would like to change the way this happens, and we want to make sure now, instead of it going directly to a wholesaler, that it goes directly to the exchange in what's called a qualified auction. And the reason I bring this up is because I think what is going to happen is that I think that for less liquid stocks, like Merchants and Marine Bank, what will happen is those wholesalers are no longer going to be willing to participate in auctions for those stocks, right? Because right now they have to, because of kind of this implicit agreement they have with the Schwabs of the world. But once you say you no longer have to honor this implicit agreement with the Schwabs of the world, they get to pick and choose which stocks they want to bid on in an auction. And they'll choose to bid on all the liquid stocks, but they won't bid on the illiquid stocks, or the pricing that they will provide will be significantly worse. And so I think what you're going to see is the markets are going to basically bifurcate, and the liquid stocks are going to do pretty well, and less liquid, smaller stocks are going to be punished, I think, in this new regime. It probably was more than you looked for, but that's where it's going.
I think we have time for one more question.
Dr. Lewis, on that line of discussion, I think that would kind of explain to a certain extent why, if you look at other analysis of the bank, if you go like to Barron's or something like that, they have it as a sell recommendation because we are trading, at less than the book value of the bank. Is that correct?
If Barron's has a sell recommendation on the bank, it's, I think, because they didn't do the research that they should have done. That they looked at this price-to-book ratio, and pretty much when you see a price-to-book ratio that small, it's telling you that this is probably, one of two events. It's probably a Republic first, or it's a grossly undervalued stock. Most stocks don't get that underpriced, so it could just be based on a simple analysis of the valuation multiples without doing any real due diligence to analyze the fundamentals of the bank.
So you're saying we probably had a lazy analyst?
I would think so, yeah.
Obviously wasn't a student of yours. So,
I don't know about that.
All right. Craig, thank you so much for being here again. We always enjoy having you. Craig was nice enough to bring Miss Terry Lewis down with him this year, his better half, and I don't think you'll object to me saying that. Miss Lewis is also an accomplished financial professional herself, so she keeps him honest. Thank you, Terry, for coming down. Thank you, Craig, for being here.
We are very proud this morning to have our Moss Point Choir, and I want to introduce these young people because it takes a lot of courage to come up and do something like this sometimes. We have Araya Davis. Did I pronounce your first name right, Araya? That's a beautiful name. All right, we also have Isabella Randalls. Isabella? Jamelin Spain, Jamelin, and Jasmine Terrell on the end over there. And these young ladies are being directed by Ronnie Ezel. He is their choir director. So folks, we'll give it to you now.
Say, can you see by the dawn's early light what so proudly we hailed at the twilight's last gleaming, whose bright stripes and bright stars through the perilous fight o'er the ramparts we watched were so gallantly streaming.
them another big hand, please. Okay, ladies and gentlemen, have a seat. I'm Royce Cumbus, and I would like to welcome each of you to our 2024 shareholder meeting. I think you'll find it very interesting. We had a great year last year, one of the best probably in the history of the bank. But at this time, I would like to appoint our tellers of election. I'd like to ask Mac Rushing and Stacy Enlow to leave the room and tabulate our attendance so we can be sure that we do have a quorum. We do feel that we have an apparent quorum. So we're going to proceed, and we'll ask President and CEO of the bank, Mr. Clayton Lejeune, to come up and make a few remarks while they're out counting the ballots. So Clayton, you want to?
See if I can put this up here without dislodging forcibly any of the other materials here. We'll see how this goes. Ladies and gentlemen, I just want to say again, good morning and welcome to the 2024 Merchants and Marine Bancorp annual meeting. For those of you who don't know me, my name is Clayton Lejeune, and I have the privilege of serving as the Chief Executive Officer of Merchants and Marine Bancorp and our subsidiary bank, Merchants and Marine Bank. Today should be a fun day. It's always fun to report really great results. But before I get into the really great results, I do want to take a minute and acknowledge the fact that the results that we're going to talk about today are not a byproduct of me. They're not a byproduct of our executive team at the holding company. Rather, they are a byproduct of the ladies and gentlemen who I hope you had a chance to meet as you walked in, our family of brands, which we have on display for you today in the foyer. Everything from Canvas Mortgage to Voyager Lending to Canna First Financial to Community of Resources, and most recently, Mississippi River Bank. We'll spend a great deal of time talking through that today, but I'd be remiss if I didn't point that out at the outset of my presentation because they really are the stars of the show. As we go forward, I also want to point out that we love questions. We like all kinds of questions, easy questions, hard questions, silly questions, serious questions. So we do have microphones that are in the audience that we'll be passing around. We'll have a couple of members of our holding company team that will help us field questions from the audience today. But we also are live streaming the event. And so we want to extend an opportunity to those who are live streaming to submit questions as well. We also know that there may be some in the audience who'd prefer to just send a question by text rather than raising their hand to get in the mic. So I wanted to start out by putting this up there. If you're curious how you can text in a question, this is the route to do that. But again, we will have microphones out there for you to use as the session progresses. So as we're thinking about the presentation, y'all know I can talk at great lengths about nothing. So when you give me an opportunity to give a presentation about a year like Merchants and Marine Bancorp had in 2023, it's really hard for me to compress that down into a package that gets us out of here in less than 4 hours, right? So I've worked really hard to try to compress this down to hopefully something that gets us through the presentation in about 30 minutes to 40 minutes. With that being said, I'm going to hit the highlights. I'm going to hit high-level stuff. Y'all have our full financial report in your possession. If you don't, I have an extra copy up front. That financial report and all the accompanying schedules and disclosures go into great detail about things that we simply don't have time to discuss today. But as we go through today, I'm going to hit 4 broad topics with you. We're going to begin by taking a look back on 23. We're going to discuss some of the factors that impacted our organization's performance in 23. And not only our organization, but we're going to wade into some of the topics that Dr. Craig Lewis talked about in the economic presentation if you were here. And frankly, some of the factors that are probably impacting you and your home budget and that are impacting other businesses around the country. We're going to then take a little high-level review of our financial performance in 2023, again, hitting cursory highlights and trying to add value to you beyond what's in the shareholder report itself. From there, I'd like to take a few moments and highlight the accomplishments of our team from 2023, non-financial accomplishments, things that you may not necessarily see in the numbers, but you really ought to know about, and hopefully you'll be as proud of them as we are. And then we'll close with a high-level overview of what we are focusing on for the remainder of 24 and really what we think we will continue to be focused on in 25 and beyond. And so with that being said, let's just jump right in and hit a phrase that if you are in banking, you're probably getting about as sick of hearing as you got sick of hearing COVID, right? We are in a phase that the Federal Reserve has referred to as higher for longer interest rates. So blast from the past, we had this thing called COVID. In response to COVID, the federal government unleashed the money cannons. You know, it was like a great talk show host, you know, stimulus for you, and a stimulus for you, and a stimulus for you, and that was great and awesome. The problem was no one had anywhere to spend the money, so it ended up inflating the money supply and sitting on bank balance sheets. Shortly thereafter, when the world reopened and people realized, hey, I've got a lot of extra cash and interest rates are really low, we do the American thing. Let's go buy something, and let's buy lots of somethings. So the inflation that the Federal Reserve and others hoped was transitory in 21 proved to be sustained and long-lasting, just as Dr. Lewis pointed out. We judge that it's highly likely we'll continue to deal with inflation just as he projected for the next couple of years. So the Federal Reserve in 22 raised interest rates higher than they ever had in a very short period of time. And in 23, we kept hearing this refrain that, you know, the Fed's going to cut rates. Fed's going to cut rates. We don't know if you know this, but inflation's under control. Fed's going to cut rates. And yet we sit here today, May 2nd, 2024, with rates still uncut. They're still at the same level that we saw them at in late 22. And for some banks, like your company, that's great. We are more profitable than we've ever been. Our metrics are great. And it's because we were fortunate to build a balance sheet to take advantage of this. Unfortunately, on the flip side, there are many banks that are struggling mightily because they did not take the opportunity to prepare for the coming storm. But suffice it to say, there are myriad impacts that are impacting our industry and frankly that are impacting you at the grocery store, right? Anybody know what a gallon of milk costs now? And I bet it's probably a lot more than you remember paying before COVID. And that is the reason why we don't think there's a high likelihood of rate drops. So our industry has been having to grapple with the construct that these high rates may be here for a long time. Another thing that I'm going to jump over real quick, and y'all see this, is a battle for deposits. So as Dr. Lewis talked about, many banks in 21 and 22 reinvested all these excess deposits, and they wanted to get the best yield they can, right? That's what you do. You want to maximize profitability. That's what we do. But they didn't consider the potential impact of rising rates on their liquidity. Not only that, they didn't consider the impact of the Fed actually reducing their balance sheet and pulling deposits out of the system. And so if you're wondering like, hey man, rates are great right now. You know, everybody, I can get a 5% CD or I can get a 6% CD. You know, and by the way, why isn't Merchants and Marine Bank doing that? I'll make a couple points. One, the banks and institutions that are paying you 5 and 6% on your money, while they may appreciate you, they're not doing that out of the goodness of their heart. Make no mistake. They are paying 5 and 6% and 7% on deposits because they're desperate and they need the funds. Make no mistake. Because many of those organizations are holding assets that are yielding them less than they're paying you on those deposits. That is the reality of the world. But it's less painful for them to pay a 5% or 6% rate on deposit than be able to, you know, figure out another way to get funding for their balance sheet. Conversely, for those of you who bank in our local trade area, you'll say, man, y'all really aren't paying 5 or 6% on deposits, man. You know, I can go down the road and get a CD for 6%. Yes. As we go through latter parts of the presentation, I'm going to show you what our strategy has allowed your company to do. And I'm going to open up a little bit about the secret sauce of our profitability, and I'll give you a preview. It all goes back to deposits. But suffice it to say right now, our industry is facing immense competition for deposits. This competition is not only coming from other banks, but it's coming from non-bank financial institutions. Schwab, it's coming from UBS, it's coming from folks outside of the traditional banking sphere who also desperately need the funds. And so this is an unprecedented time for us as an industry. Another interesting tidbit that you should know as you're thinking about our industry's performance and what we're dealing with is we have some really well-intended regulators who are trying to, at this point, clear up their reputation. right? Because regulators, unfortunately, were not prepared to stop the failure of the banks that failed last year, nor were they prepared to handle the failure of Republic First this year, nor were they in a position to prevent many hundred other banks from being in similar financial condition as these banks that have failed. And so regulators, if you think about a banker, we specialize in looking in the rear view, right? You come to us and say, hey, I'm going to go to Jonathan Jones and get a business loan. And Jonathan, here's my pro formas. I'm going to start this new business. It's going to be the best thing ever. We're going to make lots of money. That's really great. And Jonathan's going to say, well, that's great, but I need to see your last 3 years of tax returns. I need a personal financial statement. I need to look at what sort of money you have on deposit. Bankers look in the rear view. Regulators are a deviation beyond that. The only way that they're able to write rules is based on things that have already happened. And so in that sort of a situation, it draws a parallel to the old saying that to the man who only has a hammer, everything looks like a nail. And so our regulators have complicated things for our industry. They've complicated it in a few ways. One way is the conviction that regulators had early on that the housing market was going to collapse, right? Housing's just going to collapse. Builders are going to go under. So banks began pulling back loans to builders. Even builders got nervous. And yet we find ourselves today with a shortage of housing, especially in our region. I mean, there is an absolute shortage of inventory across our trade area that is stymieing many potential homeowners, many would-be homeowners, and people who maybe would like to upgrade or get a larger home, they're not able to because there's just not inventory. And that's just one example of where regulators are intent on applying rules that maybe worked for a prior disaster sort of economic scenario to a current economic scenario that may be vastly different. Other things that we continue to deal with from our friendly regulators include pressure on fees. You may hear the president or the director of the CFPB talk about fees that they are categorically labeling as junk fees. Well, we take offense to that. We don't believe as a community bank that any fees we charge are junk fees. We're very thoughtful and deliberate about what fees we charge. But there are a great degree of rumblings out there that sources of our income, for instance, overdraft and NSF fees, right? They are wanting to eliminate those fully. And that sounds great on the surface until you think about the fact that overdraft and NSF income represents 5% of our company's 2023 gross revenue. It represents somewhere around 30% of our company's 2023 net income. So it's a major driver. And underlying that is the fact that overdrafts that are made by banks like us across the country are unsecured credit. And there are a tremendous number of losses that come along with that. So those higher fees offset those credit losses that come with that. Nevertheless, that is a refrain that we're hearing from the talking heads in DC. We're also hearing a constant refrain that merger and acquisition activity is going to be under increased scrutiny. We were very fortunate. If you're thinking about our acquisition and partnership with Mississippi River Bank, that was announced September 18th. We filed a regulatory application on November 9th, and it took all the way until March of this year to get final regulatory approval, and we were fortunate to consummate the transaction on April 10th. There are bank merger applications that were filed before ours that have yet to even be weighed in on by regulators. And it's a little bit of a duality if you think about it. On one hand, we have regulators in Washington saying, hey, this bank merger and acquisition activity is hurting communities. We don't like it. We don't want it. We think it's depriving communities of more personalized, tailored services by aggregating small banks into really big banks. But by the same token, they are not willing to remove any of the regulatory challenges that are leading these very small banks to need to sell. They're not making it any easier for banks to operate at a sub $500 million level. They're just not. And so there's an immense amount of pressure being brought on by regulators. And all in all, I want to point out that the entire sector that we operate in, the banking sector, is really under pressure. If you're looking at the KBW Bank Stock Index, this is a stock index, an amalgamation of different bank stocks that trade on the S&P 500. If we're going to look at that for a long-term average, and let's say you invested $1 in the KBW Bank Stock Index in 2019, $1. Your $1 today would be worth 85 cents. So if you want a proxy for what the stock market views our industry's outlook as being, it's not very good. It's negatively impacting the way that bank stocks are valued. And thankfully, and we'll talk about it a little later, our stock is an outlier. Our stock is up pretty mightily over the last couple of years. But nevertheless, our industry has immense pressure. We do believe there's going to be continued consolidation in the industry. Even though regulators are trying to stop it and slow it, even though we don't necessarily want to see consolidation, we believe in community banking and we believe in a family of brands, we think it's inevitable. And when you see a year like last year where you had a 42% drop in the number of merger and acquisition deals announced, you know that that demand isn't dissipating, right? It's just not going away. It's being built up until it can be unleashed at some point in the future. So I know that's a little bit of a gloom and doom sort of scenario, right? We're talking about regulatory factors that are not very positive. We're talking about immense competition for deposits. We're talking about our industry having to grapple with higher for longer interest rates. And you're thinking, man, like I thought he said it was going to be good. I thought we had some good news. That all sounds really negative. Let's flip forward and talk about the company's financial performance for 2023. As we do that, I'm going to put a term out there that you have seen us use repeatedly over the last few years, and that is what we refer to as our battle-ready balance sheet. So a few years ago, in the wake of COVID, we were concerned that we may be in this sort of a scenario with rapidly increased market rates that would result in unrealized losses on the balance sheets of banks and other companies, that would incite wars for deposits, that would pressure net interest margins, and also degrade credit quality. So we set out to build a balance sheet that we believed could not only survive that sort of cataclysm, but would actually perform really well in it. And so when you're thinking about what does that mean to us, there's really just a handful of characteristics. Number one, we sought to maintain very high levels of on-balance sheet liquidity. That's like real cash in the pocket. That's not saying, hey, we can go borrow money from another bank or we can borrow from the Fed, but we wanted to have cash on our balance sheets. Secondly, we wanted to focus on our credit metrics and make sure that we had as pristine of a portfolio as we could in the event that the market gave us degradation in credit. We wanted to have really low levels of problem loans going into that. We also wanted to focus on a deposit base that, as Dr. Lewis pointed out, was very stable and very low cost, right? In banking, you build banks on deposits. Banks are not built on loans. Loans are great, loans are largesse, but you build banks on deposits. And we believe at Merchants and Marine Bank and our family of brands, and Mississippi River is a great example of this, that banks are not just built on CDs. Banks are built on core relationship deposits with men and women and families who choose to do business with you because of who you are and what you represent, and businesses who choose to do business with you because of who you are and how you serve them in the community. That was a key focus for us. And last but certainly not least was a focus on capital. Again, at the end of the day, when all else fails, that capital serves as a protector for our depositors who are insured. It serves as a protection for us as shareholders. So those were the four elements we focused on, in addition to having a team who could actually do something with all that. It's not easy to build that sort of a balance sheet, I'll say. It's even harder to maintain it over a period of time. So if we're looking at our balance sheet trends, I would use the analogy of a swan gliding across the surface of the lake, very smooth, very easy, effortless. But you know, under the surface, there's a lot of movement. A few points I'll make with our overall balance sheet trends. The dark blue line is our total assets, relatively unchanged year over year. $686 million year-end 23, $686 million the end of the prior year, maybe 678 the year before that. So not a lot of movement there. But the real story is under the surface. As you look at the growth in our loan portfolio, tremendous growth in the loan portfolio over the last few years. Not only growth in the portfolio, but the ability to reprice loans upward as rates moved up. A few years ago, our market presidents, Jimmy Conyers, Mac Rushing, Grant Walker, led by our Chief Banking Officer, Greg Hodges, started introducing variable rate loans into our loan mix. And so whereas we may not have grown as much as some, we were able to reprice loans upward much more quickly than others. At the same time, we held back tremendous amounts of cash. You're going to notice that red line get really small in 21 and 22. That's because we chose to not reinvest. during those years. We wanted to keep cash or near cash on the sidelines because we were convinced that rates would go up. And what this also does not show you is the extent to which our deposit base was completely recalibrated over the course of a few years. Our company prior to 2020 had very significant balances in municipal deposits, right? Deposits of cities and municipalities, and those are great. We love serving our local communities. We also had a lot more CDs on the books. You know, we had gotten competitive on CDs. The challenge is for many of those CD customers, and based on the fiduciary responsibility of many of those municipalities, they have to go to wherever the highest rate is, right? I mean, that's just how that works. And we judged that too risky of a strategy to build a company around in terms of our funding base. So there's a lot of movement below the scenes there. A couple of slides that I think are a real key indicator to you in terms of what our team has done from a credit quality standpoint is the reduction in our non-performing assets. Those are represented by the dark blue line in this sheet, and you'll notice that they've declined to around 2.6 million at the end of last year. That's a drop of almost half from the prior year. And they were lower at year-end 23 than they've ever been in the last 10 years. I could graph this out much further, but the trend still holds. The level of impaired loans within our company is at all-time lows. We ended the year maybe with one parcel of other real estate on the books for $23,000. By the way, if you're interested in that, we would make you a heck of a deal. See me after this. Let me know we're dealing, and you know we'll pair it with a great loan. You know our loan rates have zeros in them. Some people say they're in the wrong places. They're in the right places to us, but seriously, that's a testament to the efforts of our team to not only get our balance sheet pristinely clean, but to keep it there. Similarly, if you're looking at credit metrics through a different lens, this shows you a few different metrics that bankers like to geek out on, from our past due ratio, which is going to be the dark blue line, to the ratio of non-accrual loans, which is the light blue line, and the red line is a ratio of non-performing assets. The way I would describe this is the higher these lines are, the deeper trouble we're in. Just putting that out there. What you will notice is there's been significant reduction in each one of these metrics over the last few years. And it's even more impressive to note that our 0.25% past due ratio at year-end 23 was actually lower than our peer group. And that's probably one of the first times we've ever been below our peer group on a metric like past dues. Our peer group's past due ratio was about 50% higher than ours at 0.38%. And it may not seem like a lot. You're like, yeah, but Clayton, I mean, I see back there, man, y'all are like 3%. You know, you're going to throw stones or cast shade at somebody for a 40 basis point past due ratio. I would point out that 38 basis point peer past due ratio, which is half higher than ours, saw an increase of 25% over the prior year. So again, we're in a rate environment where rates are higher for longer. We're in an environment where inflation has been persistent, and we are seeing competitors deal with degradation in credit quality. People are struggling under the increasing rates on credit cards. And by the way, all the savings that was there post-COVID has been spent. It's gone. It's gone. We're back to pre-COVID levels. Savings rate has dropped back to 3%. Probably going to be a little lower than that as we go forward. People are struggling. And we're seeing people slow down on loan payments across the board. We're seeing commercial real estate developers who were really excited back in 2020, man, I'm going to get this commercial real estate development loan, and some bank is going to do it at 2.99% because they're desperate. Those balloon loans are maturing. And so you have some commercial real estate developers who have loans that are repricing from maybe a 3% interest rate to banks wanting to say, hey guys, prime is 8.5. And if you're a commercial real estate person who was banking on a 3 or 4% interest rate to make your project work, and now you're looking at double that, it's a scary time. It's a really scary time. Fortunately for us, we never really went down that road. When interest rates were at all-time lows in 20 and 21, our loan pricing was still very strong. We didn't do any 2% or 3% loans. That was not something we felt prudent based on the long-term history of what we saw in our country. So we stayed the course, very tried and true. We missed a few loan opportunities, but we're being rewarded with greatly enhanced credit metrics that are far better than our peer group averages now. And we're excited to have those as we go into this period of uncertainty. We wish we had a crystal ball, but in absence of a crystal ball, the best thing that we can have is a pristine balance sheet and a really large allowance for problem loans. Speaking of that really large allowance, one important note that you probably saw in mine and Royce's shareholder letter, and it's also embedded in the annual report, is our company's conversion to the current expected credit loss model in 2023. That's a fundamental shift. That's a big change. I won't go into all the details, but I want to hit a few high points with you because it's material at all, but it's even more material when you're looking at these metrics. So as a bank, we are required to hold back reserves to guard against the possibility of loans not paying, right? It's just what it is. Those are very data-driven, very complex models. Regulators like changing those models periodically based on new data that came up. And so we adopted a new model based on regulatory guidance effective January 1st, 2023. That model allowed us to put additional amounts in our allowance for credit losses. Our organization has historically had very low losses on loans. Even if somebody gets foreclosed on, we're really conservative. We've not lent them 100% loan to value. So we normally don't lose as much as peer banks. But in evaluating the potential loss, we were able to justify adding a significant amount to that allowance for credit losses. So again, if you're thinking about how do we stack up against peer, our credit metrics are now better. We have much fewer past dues than peer. Our non-performing assets are lower than peer, and ours are trending down while peer is trending up. And that buffer against loan losses that we maintain is twice as large as our peer group average. And by peer group, I mean the 1,205 banks in the U.S. that fall within $300 million and $1 billion in assets. So our allowance for credit losses is twice the size of our competition. Our credit metrics are better than our competition. And not knowing what lies in store, that gives us a lot of confidence to continue operating the bank and to continue growing, knowing that we've made the investments on the front end. Let's talk a little bit about income. Let's see, and I may have cut this off. There we go. All right, so net income. You would have seen in the annual report that our net income for 2023 was just a little bit over $6 million. As best we can tell, this is a record high from a core income standpoint that equates to $4.53 per share. From an earnings per share standpoint, true high watermark for the company. There are a lot of factors underlying that. I want to unpack just a few key ones. One, our company did receive an Equitable Recovery Program grant through the CDFI fund. As we discuss in our shareholder letter every year, being a CDFI, a community development financial institution, is a core part of our business model. It's something we do. In broad brush terms, what that means for you is that we are willing to provide financial services to all segments of our community, not only the highest and best equipped borrowers, but also those who need a hand up to improve their station of life. That's a core tenet of how we operate. Over time, being a CDFI has given us access to grant funding, which has not only helped us build infrastructure, but helped us funnel funds back to our communities. It also allowed us to participate in the Emergency Capital Investment Program back in 2022, which gave us access to an additional $51 million in preferred capital, which has a maximum lifetime interest rate of only 2% on it. So there's a real impact to us from a positive standpoint. And while it may be easy to say, yeah, Clayton, y'all got $6 million in that income because you got this big grant, it's important to note that the vast majority of those grant proceeds were already earmarked for specific expenses like donations into the communities we serve, retention bonuses for non-executives. So put that out there. There's no executive on our team, including myself or any of our brand executives who you met out there who got $1 from that, but we use that to help our rank and file team members who are being squeezed by inflation. We used it also to stand up new loan programs to help us better serve the communities we serve. So those combined expenses, the donations, the assistance for our rank and file individuals who are struggling under the weight of inflation, the startup costs for the new loan programs and other services is what led to that corresponding increase in non-interest expense, which you probably saw that in there as well. The other thing that led non-interest expense up, our operating expenses up, was merger-related costs to our acquisition of Mississippi River Bank. Merger and acquisition activity is very expensive. So from our vantage point, as best we can, if we strip away the net impact of that Equitable Recovery Program grant on our financials, and then we factor in the merger costs that we absorbed as a company to bring our friends at Mississippi River Bank into our family of brands, they're not far from being a wash. So that $6 million in net income that you saw last year is true blue, core, recurring sort of income from our vantage point. As we fast forward to the first quarter of 2024, I wanted to walk you through a few things there. You're going to see a dark blue line. That represents the annualized earnings of our company through the first quarter of 2024. And you're going to think, man, like we fell off a cliff. You just said it was recurring. What's going on with that? The annualized figure in the dark blue is inclusive of a very significant amount of merger and acquisition costs that are non-recurring, right? Our transaction with Mississippi River Bank has been completed. Those costs are not going to recur, but they're very heavy. It's about $500,000 in added expenses in the first quarter based solely on that transaction. So adding the light blue line back, the light blue line represents the annualized rate of those fees. So if you're comparing apples to apples, the combined dark blue, light blue line that you're seeing on your far right, that's really where we're trending based on Q1 data. It's also important to notice, if we were to go back over history for our company, we tend to find that the first quarter is often lower from an income standpoint than almost every other quarter. That's due to things like audit fees associated with our annual financial statement audit. It's due to regulatory assessments. It's due to just certain billings with certain vendors that all seem to hit in the first quarter. And so generally speaking, our first quarter is going to be lower, and then we see a rapid increase. The other thing that's important to note is even adding the light blue and the dark blue lines together, none of those factor in the added revenue from our friends at Mississippi River Bank. So we were excited last year to have near a 1% return on assets, right? That's in banking, that's the gold standard. You want to have a 1% return on your assets. Our friends at Mississippi River Bank had a 4% return on assets. They were industry leading level profitability last year. Consistently, Mississippi River Bank under Mike's leadership and Lisa's leadership has been north of a 2% return on average assets. So suffice it to say, adding in, if we were to put another line in there to say, hey, this is what we think we'll get from Mississippi River Bank, it'd be very significant. Just want to put that out there. Beyond that, I wanted to begin unpacking a little bit for you in more detail what we refer to as the secret to our success. And this goes back to that battle-ready balance sheet. So 3 lines on the chart. You're going to have a green line, which represents our pure net interest margin. You're going to have a dark blue line, which represents our net interest margin. The red line at the bottom is our return on assets. So let me unpack this a little bit. Most businesses have a gross profit margin, right? You know, revenue minus cost of goods sold gives you a gross profit. Think of that as our net interest margin. That's our core profitability metric. So as you notice, historically, we have always been lower than peer by a pretty wide margin in some cases. And that's been due to the composition of our balance sheet, right? We typically had low loans, we had high securities, and we had some municipal deposits that drug those numbers down. What you will notice from 2019 to present is the results of us building a battle-ready balance sheet. You will see our net interest margin go from trailing peer to now being far above peer. So if you're looking at where we ended year-end 23, our net interest margin was almost 5%. We were in the top 94th percentile of our peer group. Out of 1,200 banks, we're in the top 94th percentile in our peer group. Our margins improved to almost 5.25% in the first quarter. I mean, it's gotten even better in the first quarter. And so when you're thinking about, man, that's a 38% increase from 22 to 23. And man, if you go back to 2020, you've grown your margin, your gross margin by 57%. How did you do that? We would say it goes back to the intentional retooling of our balance sheet in the wake of COVID. So when you have a deposit base that is as stable and as low cost as ours, it's based on core operating accounts, core relationship accounts, and you pair that with market price loans, you get those sort of results. That's what is leading to that success. Do we think that the margin stays at 5.5 or goes to 8? Probably not. I'm just going to be real honest. We don't know that it does. But it's also important for you to note that we built in downside protection as well, and we'll talk through that in the key accomplishments slide. What would cause our net interest margin to decline at this point is a decline in rates. If the Fed comes out and says, hey, Craig's wrong, we're going to drop rates 4%, yes, net interest margin is going to go down. But it's important to note if the Fed does that and drops rates materially, we now have at least 2 business lines that would pop up and spring into action, one being Canvas Mortgage. I'm looking at Mary Megan Parker, who lives on the Eastern Shore. You have Donnie Anderson, who's here, the whole team, Danelle and Nicole from the ops side. We have an entire mortgage company that would spring into action because all the folks who have 7 and 8% mortgage rates are surely going to refinance if rates go down to 4 or 5%. And so that is some downside protection that's baked in there. Lastly, I do want to point out the red line at the bottom, that return on average assets. Again, the same reason that we discussed net income being down in the first quarter, merger costs, one-time related expenses that hit us every quarter, that's why that return on assets line is down. I did not adjust this to net out those expenses, but I do want you to look at the correlation in the improvement in net interest margin. So if you're looking at the uptick in the blue line, and you see the corresponding uptick in our profitability, based on that, you see the red line ticking up in 23, and you see where the net interest margin is now and where it's trending, a high correlation between our company's net interest margin and our profitability. So I'll just leave that at that. High likelihood that profitability will bounce back and the numbers bear that out. All right, last thing I want to hit as we go through the second to last thing I want to hit before we go through the financials. This is a new slide for you. A core benefit that we are seeing now, based on the way our balance sheet is structured, is a rapid expansion in the economic value of equity of our company. So let's unpack this a little bit. Blue line is book value per share. We know book value per share, total assets minus total liabilities divided by total shareholders' equity. Blue line is that. The red line is a reflection of the fair market value of a share of stock as determined by the economic value of equity model. So in the red line, we're taking, and not we, but we have a third-party firm, Olson Financial, who does third-party fair market valuations. They go and they say, based on prevailing market rates, how valuable is your deposit base? Based on prevailing market rates, how valuable are your loans and securities? And the difference between those is represented in that red line. So you see a massive increase in the economic value per share. And if you're wondering what that graphs out at, that's somewhere around $128 per share. Again, that's impacted by things like market rates. So if our balance sheet had been constructed differently, it would not be near that high. But the economic value of equity per share is now radically higher than the book value per share. And that's a direct result of the loans we have being at market rates. We don't have any real low, real cheap bonds or real cheap loans on our books, but our deposit base is really cheap and really stable. And you combine those and you get this sort of result. Very, very last thing on the financials, and I do want to hit this just high level. You've seen this slide in one form or another over the last couple of years. So looking back at 20, 21, and 22, we always get the questions, man, what happened to y'all in 21 and 22? You fell off a cliff. What happened? The easy answer is always, well, we had about a third of our total assets sitting in cash, earning nothing, zero, because we chose to not reinvest that cash and put our shareholders' equity at risk in an ultra-low rate environment. This graph shows you what would have happened. It shows you what the impact would have been had we reinvested those proceeds at the end of 2020. And again, at the end of 2020, we were being told by everyone, every talking head, every regulator, every bond salesman, the Fed will never raise rates. You need to go long. You need to lock in yield. You've got to do something with your earnings. It's a dereliction of your duty as CFO, and Casey got a lot of heat too as well. It's a dereliction of your duty as CFO, or you're doing a horrible job as CEO by keeping all this cash. You're doing nothing for your shareholders. The two graphs show at the top the actual unrealized losses that we have in terms of bonds. So yes, we have unrealized losses in our bond book. Rates continue to go high. We have somewhere around $16 million in unrealized bond losses. If you compare that back to peer group, we're in the bottom 20%. So 80% of the banks, that 1,200 banks in that peer group, have more losses than we do, unrealized losses. The bottom graph shows you what would have happened to your company had we followed the same path that everybody else followed. Not everybody, but that many followed in late 2020. Had we taken that extra $200 million that we had in cash and invested it in a 20-year U.S. Treasury security, that loss would have increased from $16 million today to north of $80 million. It would have completely evaporated all of our company's tangible common equity if we had simply adopted the strategy that everyone was pressuring us to adopt. And so when you're thinking about, our earnings were down in 21 and 22, we would offer this. While our earnings may have declined from a historical level of 4 million, 4.5 million to maybe 2 million, we just saved $70 million in shareholder equity. So we sacrificed a couple of $1 million in earnings per year, never suspended our dividend, never interrupted the dividend, but we did that in order to save this type of shareholder equity. It would have been catastrophic for us. And I also want to point out that while we were fortunate to get ahead of this, there were many banks who didn't. And when you look at banks like Republic First or Silicon Valley Bank, or you name one of the bank failures or the banks that are struggling today, this is what they're dealing with. They're dealing with the repercussions of having a vast pool of assets that are priced way below market that they can't liquidate, they can't do anything with, lest they recognize these losses and become insolvent overnight. All right, let's transition and talk about some of the key accomplishments of our team over 2023. Very important to note that while we're always focused on financials, we're focused even more on moving the company ever forward. So a few highlights I'll hit. First and foremost, we are very excited and honored to welcome Mississippi River Bank into our family of brands. As I mentioned, I gave you the dates. We announced it on September 18th. We filed regulatory applications on November 9th. Regulatory approval was received in March, and the transaction was closed April 10th. We were one of very few banks to actually announce a transaction in 2023. Our partnership was really unique, and we're one of even fewer transactions that was able to be closed. While there may have been 112 transactions announced, all those have not closed, and many have been withdrawn due to the regulatory scrutiny. Why this matters? Number one, Mississippi River Bank is a community bank just like us. It's important to note their name is not going to change. They're not going to become Merchants and Marine Bank. Under our family of brands model, Mississippi River Bank's names stay on the signs, their leadership stays in place, and their unique blend of community banking in Plaquemines Parish and the West Bank goes uninterrupted. They stay them, and that's great for their clients, that's great for their community, and the same way that it's great for them is also great for our communities served by Merchants and Marine Bank, because the same firewall that protects them from losing their identity will always protect Merchants and Marine Bank from losing its identity in Jackson County and throughout the Mississippi and Alabama Gulf Coast. That's the way it's built. We've already talked about their profitability, one of the most profitable banks in the country. You think our deposit base looks good and cheap, you should see theirs. It's remarkable what Mike and Lisa and the team have built together. And we're thankful to have Mike and Lisa and Michael O'Connor with us here today. You have the team that's been running this organization at high levels of success, staying on and coming into our family of brands model. As we continue to grow and we have other opportunities to grow our family of brands, this will be the route that we use. We really believe in the multi-bank approach because at the end of the day, people like banking with people that they know. There is value in being hometown. There's value in being local. As long as you can provide competitive services and competitive pricing, we think there's always a place for that. And this is going to be our model going forward. At the same time, we saw tremendous growth in income, tremendous diversification in income in 2023. This is a direct result of the investments made in 20 and 21 and 22 into new divisions like Canvas Mortgage, divisions like CanaFirst Financial, divisions like Voyager Lending. For the first time in our company's history, total revenue crossed $40 million. We earned more in gross revenue last year than $40 million for the first time ever. That was driven in part by the grant funding we talked about, but it was driven even more by repricing loans upward. Our loan interest income alone grew from $19 million in 22 to more than $25 million last year. At the same time, we saw additional income coming in as Canvas Mortgage scaled up and began originating mortgages, selling those off in the secondary market. The same thing with Voyager Lending. I know Matthew McKelvin and Joanne are here. Dennis Tynes is also here too. As they've ramped up, we now have diversification in revenue. You may say, but yeah, why are we making all these investments? Why don't we just keep that money back and let's just make even more money, right? The reason that we believe we need to continue diversifying revenue is because we ultimately don't have full control of our destiny. When we have policymakers in Washington, D.C., and we have career bureaucrats who sit atop regulatory bodies that are not elected by us, we don't elect them. These aren't our congressmen. These aren't our senators. These are career bureaucrats who can come in and eliminate 5% of our gross revenue or 30% of our net income. We have to diversify. That's too great of a risk to thumb our nose at and say we're just going to take short-term gain to defer long-term pain. So very significant growth there. We've already talked a little bit about this in terms of our ability to leverage that battle-ready balance sheet to do things that are really remarkable, like catapult our net interest margin to new heights that it's never been before, to keep deposit costs low. I'll also offer to you that the fact that our financials are as strong as they are is without a doubt one of the reasons that our bank was approved to actually have a merger transaction with Mississippi River Bank. There are many banks who, when they file their regulatory apps, get a call from the regulators saying, hey, guys, I'm sorry, your numbers aren't going to work. We can either deny this application or you can withdraw it. And our balance sheet is so strong that we don't have to worry about that. But it's also important to note that this allows us to take care of existing clients very well. This strategy means that we're not in a position where we're having to take folks' loan costs through the roof to offset bad decisions that we've made in the past. We can continue to be that consistent, tried and true community bank for our loan clients as well. Last one that I want to hit, and you've seen this team out there, looking at Reese Fleming now, he's a part of the executive team for Community of Resources. But to support the growing family of brands that we have now launched a full-fledged bank services company. We call it Community of Resources. And this represents all of our non-client facing functions within the bank. Human resources, credit, compliance, the whole kit and caboodle. And they are there to serve our family of brands. They're there to serve each one of those companies the same way those companies serve their customers. Key differentiator for us, there are no banks that are doing this, and we think they're missing the mark. Most banks grow through acquisition, get to the point that they can't get any bigger because of operational inefficiencies, infighting, and problems, and then they try to figure this out. We invested in figuring this out on the front end so that we can grow with confidence as we go forward. Looking ahead to 2024, I want to hit these just real fast, and we're going to break. Number one, we will continue to focus on properly integrating Mississippi River Bank into our family of brands. We don't view Mississippi River Bank as a transaction. Just like our legacy bank brand is never viewed a loan or a deposit as a transaction. We believe in relationships, and relationships take time. There's no way to short circuit that. So we will continue focusing on working with Mike and Lisa and Michael O'Connor to properly integrate their team into our family of brands to not only optimize their performance and to help them achieve their goals, but to help our company continue moving forward. We want to do it the right way. because while Mississippi River Bank may have been our first whole bank acquisition, it likely will not be our last. And we want to learn through the process, and we want to make sure that we don't lose what makes us unique as a community bank, and that we never cause them to lose what makes Mississippi River Bank unique as a community bank as well. We're going to continue focusing on this family of brands concept. We have many of those brands that are now entering their maturity. We have some that are showing signs of growth, and it's really encouraging. But from a revenue diversification standpoint and a return on investment standpoint, making sure these brands have what it takes, and whether that's the support, the financials, the encouragement, or the resources, we want them to grow into their full potential across the board. That's a key hallmark of our success in the future, is making sure these brands get to a place that they continue functioning at high levels, adding value back to the company, and helping us outpunch the competition. Last but certainly not least, we're not done leveraging the battle-ready balance sheet that's been built. And I know you've heard me say that term so much, and sometimes I feel bad. Casey and I talk about it, man, maybe I shouldn't say it anymore. But the reality is that is a hallmark of why our profits are what they are. This is the reason why we will be able to continue to have the growth that we have had, and why our profitability outlook looks so positive is because of this battle-ready balance sheet. So again, we'll continue focusing on keeping high levels of on-balance sheet liquidity. Just like cash in your pocket gives you options, cash in our bank's pocket gives us lots of options. We'll focus on keeping our house clean. We don't want problem loans. We don't want to make risky loans. We don't want to get caught up in what the crowd's doing, because generally the crowd's not doing the right things long term. We're going to always keep high levels of capital on our balance sheet as well. Key hallmark of what we're going to focus on there. And we'll never lose sight of the importance of deposits. Banks are built on deposits. And so when we look back to 2020 and we remember that banks were closing deposit accounts because customers had excess deposits, do y'all remember that? We see the fallacy in that short-term thinking, and we will always work to avoid that. So y'all, I know I've gone a little long, but I do want to open it up for the Q&A session. For directional purposes, we're going to have Greg Hodges, tall bearded gentleman on my right, who will be fielding questions that are coming in through the text app. Greg is our Chief Banking Officer at our holding company. We'll have Antonio Davis on our left. Antonio is our new Chief Risk Officer. He's a relatively new addition to the team. If you've not met Antonio, would encourage you to take some time to get to know him. And then I'm going to ask Casey Hill, our CFO, to join me on stage to help field the questions. I'll tell you, if they're hard ones, I'm probably going to punt them Casey's way. So, but seriously, thank y'all for the time.
Great job.
Got me? Yeah, there you go. All right, so I do have quite a few questions that have come in through the text feature, and continue to use that if you'd like, if you don't want to raise your hand. But I'll go ahead and start us off. There was one question that came up early that you touched on, but I do want to give you a chance if you want to add anything. So that was a question about the CDFI-related income, the increase there, as well as the increased expenses. I know you touched on that. Is there anything else you want to add?
Yeah, so thank you for whoever submitted that question. I do want to point out that philosophically, being a CDFI is a core part of our business. It adds immense value to us. It's a differentiator. Of the 4,000 banks in the country, only 200 of us are CDFIs. It's an automatic differentiator. It gives us access to programs like ESIP. It gives us access to grant funding. But the other thing that Casey and I believe, and I don't want to speak for you, but I will, is, and our board has allowed us to buy into this, is that when there is one-time money coming in, we believe in reinvesting that one-time money back into the company so that we can hopefully generate recurring returns on investment, right? It's really easy to win the lottery, and then most of those folks end up broke, right? A few choose to invest the proceeds, and you never hear from them again. They don't end up on a TLC show chronicling their life and how they fell from grace. And so I will point that out as well, Greg. In terms of CDFI proceeds, if there is excess from CDFI grants, we try to find ways to reinvest that back into the company. And I know Casey has a lot more details on that.
Yeah, I'll just expand on that a little bit. So you see income at $6 million last year. If we weren't investing in the future, we could squeeze a heck of a lot more out of our balance sheet than that. But we'd be squeezing it from the future, right? So we can either choose to take a chunk of our income every year and invest it in new brands, in new lines of business, in new markets, and in new partners, or we can kind of give up on the future. And I think any time that you're taking from the future to make yourself look good or feel a little bit better right now, you're doing yourself and your shareholders, anybody that supports you, a big disservice. So we try to avoid that as best we can.
All right, I'll keep reading. Next question is around dividend. So there's a proposal to remove the preemptive rights and allow the bank to issue equity offerings. The expectation for shareholders then is to see both equity dilution and stock price devaluation while you issue equity. What are your future plans for your dividend, and how can you expect the dividend to grow since you are diluting us?
Sure. So there are a few different elements of that question. So I'll start with the preemptive rights piece. So our charter has long had preemptive rights in it. What preemptive rights in essence do is not prevent a company from issuing equity. A company's board can always issue stock, but they do add a lot of complication and cost to the process by interjecting interim steps. So if our company were to issue stock with preemptive rights, we would first have to offer that stock pro rata to all existing shareholders, have a shareholder meeting, take on a lot of added expense to simply go through that. And then if shareholders didn't take down additional stock, we would just sell the stock like you normally would. You would sell it in the market, or you would place it privately. So our view is, over time, based on our research, our stock is much more widely traded. This is no longer a stock that you can only buy if you know somebody, or that you can only trade across the desk. Our stock trades openly on the OTCQX markets. And in fact, we were one of the top 50 companies on the OTCQX markets last year. So knowing that stock is much more easy to come by, we see that as companies grow and you hit that place that we're at in terms of not having any big shareholders, our largest shareholder is not a principal shareholder, and knowing that stock is very easy to come by, we judge that the added benefit is not enough to offset the added cost of going through the preemptive rights process. I will say it is very, very common for these to no longer exist in companies once they are broadly and more widely traded. I'll add on to that Casey and I are both shareholders. Most of my wife and I's personal net worth is tied up in bank stock that we've bought, right? We don't have grants or options or anything. So our interests are very well aligned with shareholders when it comes to things like dilution. We don't, on the surface, desire to dilute any shareholder. So when we're looking at future equity issuances, those will only be considered when there is a net, very demonstrable net benefit to all shareholders. The last thing we want to do is issue stock just for issuing stock's sake. We want to have the ability to issue stock in ways that adds even more value to you as shareholders. And while let's say we had someone who owned 10%, I would much rather own 1% of $1 billion than 10% of $1 million, right? And so having that ability to issue equity capital to fund growth over time is going to add tremendous value to shareholders. Casey, what do you want to weigh?
Yeah, and if y'all disagree with anything I say here, the guy that taught me all this is sitting right back there, so y'all can take it up with him afterwards. But in the environment that we're in, and we've made no secret that we plan on growing, right? It's just like any other industry. You can grow or you can die, and we choose option A. In that environment, there are two types of transactions. There's a cash transaction, which is what Mississippi River Bank was, or there's a stock transaction. Well, in order to perpetuate a stock transaction, you've got to have an additional liquidity in your stock and the ability to issue shares. Now, we will only do that if our stock is valued at a higher multiple of tangible book value than our targets, right? And what that does in a transaction like that delta between where your target is valued and where you are valued, is accretive to existing shareholders before the stock issuance. It means your stock gets more valuable even when considering any dilution that occurs per share, and you get wealthier. So we would never, because as Clayton said, my kids can't go to college if something happens to our stock, right? So we would never do something that will be price dilutive or value dilutive to our existing shareholders. It would be shooting our own selves in the foot.
Yeah, and along those lines, a question I do want to point out, maybe this wasn't asked, there are no immediate plans that issue stock. There are no immediate plans. Hopefully, as you think back on the presentation and you reflect on, how proactive we aspire to be, we're not always, but we try. We work really hard to look ahead. This is not something that we need to issue stock today, but we do see opportunities in the future, 2 years, 5 years, 10 years down the road, when we will need that as an option to leverage to bring to the table.
All right. Any other questions here? I got more on my phone, but y'all don't like to hear me read that much.
And I just want to add real quick, me and Clayton will be around. We're always around the bank.
Of course.
If y'all have any follow-ups to this that we didn't answer, please feel free to call us or reach out to us. We want to talk to y'all about it.
I got some more. All right, so y'all continue to grow, and we like seeing that, but what does that mean to Pascagoula? We all leave Pascagoula.
Yeah, so the short answer is Merchants and Marine Bank will never leave Pascagoula. Pascagoula gave birth to Merchants and Marine Bank. It is our corporate domicile. It's our corporate charter. That's where our corporate headquarters is. And Merchants and Marine Bank will never leave Pascagoula. As we continue to grow, and if we continue to be blessed with continued growth, you may see people move around to different roles, but Pascagoula is and always will be home. And we judge the absolute best path for us to always be able to take care of Pascagoula is to make this bank as profitable as it can be and to make it as strong as it can be, so that that corporate seat never leaves Pascagoula, so that it's never something where some bank comes in and buys us and then all of a sudden, we're assimilated into, some big regional bank. So Pascagoula is always home and will always be where our company is chartered.
Another question about growth. What is Merchants Marine Bancorp's future growth target, and what percentage of future bank growth do you expect to come from organic versus inorganic?
Sure. So I'll give some high-level commentary, and then I'm going to defer to Dr. Hill to give a little more detailed info there. We do think there will be tremendous opportunities to continue growing this franchise. I will tell you that as word has gotten out and we have been able to bring to life this family of brands concept, there is immense interest from other banks to join our family of brands. It's a unique path. You really get the best of both worlds. You get to keep what makes you unique as a brand. You get to keep the name on the sign that people's dads and granddads served under. You get to keep local leadership in place that has real autonomy to make real local decisions. But you get to blend with that the back office of a much larger company. It's something like Community of Resources that can really supercharge your ability to compete with anybody and to provide service to everybody. There is immense interest. I will say there are no arbitrary targets. It's not that we want to cross some sort of arbitrary size threshold. Rather, we want to be very selective on what brands and what banks we admit into the fold. We looked at numerous franchises prior to partnering with Mississippi River Bank. We walked away from all of them, frankly, because we didn't think they had the right blend of community orientation, the right blend of real balance sheet strength, and the right leadership, frankly, like Mike and Lisa and Michael O'Connor represent. And so for us, it's not so much about arbitrary size targets or hitting some sort of threshold. It's about finding the right members to bolt into that family of brands that don't dilute what we do and that don't detract from our core mission.
Yeah, you hit every point. The strength that we've had, the greatest strength that we've had, aside from our people in the last several years, is our ability to pivot very quickly. We're not going to go out there and lock ourselves in to say we're going to grow by 15% every year come hell or high water, right? So we're going to be opportunistic, but we're not going to be driven so much by growth that we make bad decisions in who we partner with. Mike and Lisa and Michael O'Connor and the MRB team and what they built was class-leading return, right? We were able to get them on. They will be, they have been already, and it'll start showing up in the numbers as we publish financials in the next couple of quarters. They've been immediately accretive. Great asset quality, great quality of people. That's what we're looking for, right? Organic-wise, It depends on the economy. We're not going to go out there either and say that we're going to grow loans by 15% every year if we can't find 15% in quality loans. We're not going to do something or load something onto the balance sheet that's going to create a problem for us and for you over the next 3 or 4 years. So we're going to grow. We're going to grow as much as we can do in a quality way.
And there have been other questions that I think fit right into that, and so I am going to skip over those. So if you've sent the question about growth, I got it, but I think they covered acquisitions for 2024 and beyond. One of the other questions that just came in was about preemptive rights again, and it was asking, would the removal of preemptive rights also allow for Merchants Marine Bank stock dividends to be reinvested?
So our hope is to allow for that. I will say we have had strong interest in that. We are actively evaluating what options we may have to allow that sort of a program to exist. I know there's strong interest from some shareholders who don't necessarily need or who would prefer to reinvest rather than receiving the dividends as income or spending money. But we're actively evaluating that, and as we get clarity, we'll certainly communicate out to shareholders.
Okay. All right, so about the stock. You spoke about the stock trading more traditional public avenues and getting credit for volumes. This question is, do you anticipate reevaluating where stock trades? Right now we're on the OTC. Would you look to be on New York or NASDAQ?
Yeah, so I'll throw in with some high-level philosophy, and Casey can give you a lot of the details. Eventually, over time, you may see us move off the OTC markets. However, it's important to note that when we move from OTC markets to something like the NASDAQ or the New York Stock Exchange, it brings with it a lot of added costs and a lot of added requirements on the company that we want to make sure benefit you as shareholders. The last thing we want to do is to go ring the bell on the stock exchange and feel real good about ourselves, but have the added cost degrade the earnings potential of this company, right? Because at the end of the day, we view the best judge of our performance as earnings per share. I mean, how do we grow the continued earnings engine of this company? And so over time, yes, you may see us do that, but as with issuing additional shares, we want to make sure that any sort of uplisting transaction or decision to re-register with the SEC is going to bring with it real tangible benefits to shareholders in the form of increased trading volumes or increased publicity. And we want to make sure that we have the size as a company to generate that sort of interest. What we would not want to be is a $400 million bank that trades on the NASDAQ because there's no interest in those sort of companies. Now, you know, a $2.5 billion diversified financial company that operates throughout the Southeast, probably going to be some interest in outside investors in something like that. So we'll feel our way through that.
Yep. No, that's it. That $2.5 billion number he threw out, it's not by accident. That's usually about what you see for banks right now that get picked up by an index like the Russell 2000. When you go to a NASDAQ or an NYSE or some other exchange like that, you really need to get picked up by an index to really focus attention on your stock. And when you get that attention focused on your stock and you've got 3 to 4 years of high performance and things like that, like we're building in now, then you start seeing big stock appreciation, and hopefully we'll get a lot closer to that economic value of equity, what our true value is in today's dollars versus where we trade at because of limited liquidity in our stock. But we do have a plan to get there.
Yeah, and Greg and Antonio, we may do one more. As Casey mentioned, we'll be around, but I know we're kind of coming in on our time, so would love to open it up. And I know we have many students and scholars that are here. I mean, if y'all have any questions, we'd love to entertain those from y'all too. All right, well, folks, thank y'all so much for the time, and we'll go ahead and return the floor to our chairman of the board, Mr. Cumbus, to give us an update on the votes. Thank y'all.
Thank y'all. Appreciate it.
Hey, thank you, man. Appreciate it, man. Thank you. Good job. Appreciate you. Likewise.
The proxies back And of course, we do have enough to have a quorum. Of the 1,130,000 proxies sent out, 883,239 have been returned. That's a total of 64.89%. So we do have a quorum, and we can continue with our meeting. Let me go back real quick. At this time, and I'll give these to Jackie. I'll give you these numbers, Jackie. We need to incorporate these into the minutes, and I've got a written figure for you. Okay, so at this time, I'll call the shareholder meeting to order. And our first order of business would be to read the minutes of last year's annual shareholder meeting, which was held on May 4th, 2023. Okay. All right, I hear a motion and a second that we waive the reading of the minutes. All those in favor of that motion say aye. Any opposed? Okay, our first order of business, we have two things here actually. We want to elect directors serving the next term, which is Class 1. Those directors nominated are Clayton LeJour, Diane Payne, Dr. Jay Willis, and then also in Class 1, we have put up for nomination Mr. Bragg Van Antwerp. And we will pass those ballots out if you would like to fill them out by hand. We also have an amendment for the company's articles of incorporation that we'll be voting on, and we recommend that as well. So we need to pass those ballots out. Anybody want to vote in person, just raise your hand, and we will get those ballots to you. I think Jeff Hammond and Jeffrey Trammell will bring those over to you. And if need be, we can call a recess until we accomplish that. Are the ballots being cast now? But they may need to bring the singers back in for a little entertainment.
While we have a little bit of an intermission,
Sure.
waiting on this, I may add for the group in attendance, I know Mayor Knight, who welcomed us in this morning, pointed out the fact that almost a year ago, Moss Point was ravaged by a tornado. We are very thankful to have no loss of life. We did have folks in our former Moss Point branch office who are working out of an insurance company there. Just wanted to let y'all know we are excited to begin moving forward with rebuilding that Moss Point branch office. We will have a groundbreaking on the afternoon of June 18th. If you're interested in coming, help us celebrate that. We'd love to have you join us. It's going to be on site at the branch, just a little bit south of here. If you're curious what that looks like, we have renderings of the exterior of that new branch office sitting near the Merchants and Marine Bank table out front. I will point out the size of that building is deceiving. It is a lot taller and whatnot than you may be able to tell from looking at the front of that. But we are excited to get building underway with that Moss Point office. Again, that's going to be June 18th at 3 p.m. Our Chief Administrative Officer, Christy Maxwell, has ordered in some really cool spring weather for that. So it should be really nice and cool temperatures. But I would still dress for being hot because it's probably going to be hot. But Royce, I hope that filled enough time. Thank y'all.
It's a timely announcement. The progress on that building has really come along too. We appreciate all the folks, the city, the kind folks there that have helped us clean the debris and get back started quickly. So, all right. Got it? All right.
Thank you. For the election of the Class A Board Directors, Diane Payne received 785,414 votes for, which is a pass. Dr. Julius Willis received 783,410. Clayton Legere received 786,368 votes. And Bragg Van Antwerp received 782,761 votes. So all those have been passed and approved. For ratification of T. Lott for our bank's independent auditors, we received 856,011 votes. So they remain as our bank's independent auditors. And to delete the 10th article, which relates to preemptive rights, thank you. Received 715,920 votes. So that's been approved also. Thank you.
Thank you. All right. Thank you very much. It was a good vote. Thank you, Jeff. I might mention, too, that Jeff Trammell is from Louisiana, and he has been a big reason why we were able to negotiate this deal with Mississippi River Bank. You have to speak Cajun when you go down there. I mean, we know that. So I had a buddy from Houma one time, and he could speak it. Okay. I think we have very little business to conduct for the remainder of this meeting, but I would like, at this time, I would like to ask our retiring director, Mr. Thomas B. Van Antwerp, to step forward, please. Tom? Gypsy, you want to come up with him? That's up to you. I can come down here. We just want to thank you for all that you've done. I mean, really, and for the tremendous commitment. Tom, like me, has reached an age where we have a requirement that you get off the board as far as the regular voting member board. But he has come over for the last 40 years, driven Interstate 10, which is like a racetrack, if anybody.
I probably passed a lot of you.
Well, you have to drive it like a race car driver to survive, though. But anyway, he has been very instrumental in the success of this bank over that 40-year period of time. And, of course, we're going to miss him. But at the same time, I might say, we did elect you as a senior advisory director. So we do hope to continue to benefit. And we'll be able to use those 40 years of experience very well in the future, too. And so we just keep building and keep going to the next plane. It gets better all the time. So thank you very much.
Thank you, Royce.
Thank you.
Thank you. Appreciate you. And of course, we have Bragg coming on too, and he's already helped us quite a bit. So the whole family, we thank you. All right, I think that is all we have on the agenda for today. Is there anything else anyone can think of you'd like to talk about, or another question? If not, we'll entertain a motion to adjourn. All right. I have a motion to adjourn. Have a second. All those in favor of the motion say aye. Any opposed? All right. We are officially adjourned. We appreciate all of you being here. It's been a good meeting and look forward to seeing you again soon. Okay.